Hello and welcome to Switzer Investing TV. I'm Paul Rickard filling in for Peter Switzer. Well, we're right in the middle of reporting season, week 3, and my first guest tonight is Adam Dawes from Shaw and Partners. In particular, I want to catch up to see what's going on in reporting season, but also to look at banks and see how Commonwealth Bank is faring in light of some of the other reports from both Westpac and NAB. Adam joins us first up. Following Adam, Paul Black is in the studio with Peter. Paul Black is the CEO of WCM Investment Management, the people behind WQG and WCMQ. Now, they've got a really interesting approach to management. It's all about cultures and moats. And Peter had a terrific interview with Paul the other day. And this is some highlights. We just want to share what the process they go through in terms of identifying stocks for their portfolio. Fantastic investment performance and a really interesting just to suss out exactly what they look at in how they pick companies that win. But first, here's Adam Dawes from Shaw and Partners. Adam, thanks for joining us.
It's great to be here. Thanks so much.
Well, let's kick off with the banks. We've now seen a full-year result from Commonwealth Bank and 2 quarterly reports from Westpac and NAB. Let's stick with the Commonwealth Bank. A lot of people have been saying, I think me included, and perhaps you as well, that CBA was way overpriced. Interesting, today it's about just under $170. It peaked at $190 back in the middle of June, or the 25th of June. I'm just wondering, we saw last week's report, the stock down. Do you think the writing's on the wall for CBA finally?
Look, I definitely think that there's starting to see a rotation out of the financials, and especially because what we've done is we've certainly seen the resources over the last 2 to 3 weeks do a lot of the heavy lifting to keep that the ASX 200 near all-time and all-time highs. So I think that is something that I think that is looking really, really good, that there is that rotation out of the banks. Certainly the rotation from CBA, look, they did up the dividend from $2.50 to $2.60. That's coming out in a couple of days. That's obviously going to put some more pressure on the stock. And I don't know why you just sort of wanted to be buying it up here with a sort of a yield of sort of a 2% with, PE ratios in the 20 plus times, which makes it very, very expensive on global standards as well. But going into the result looked okay. Costs were okay. Their NIM was at 2.08, so I think that was in line with expectations. Their CET1 ratio was around about that sort of 12 times, which is very healthy for the bank. So look, I thought it was a good result. Certainly, it did on the day, I think, or close to that day, it lost $10, and everyone kept sort of ringing up saying, "Oh, what's going on with my portfolio? It's lost money." And I'm like, "You're overweight CBA." So yeah, look, it's a good lesson for investors not to be, fully invested in one stock and have a diversification or diversified portfolio. Do I think it's over for CBA? No, I don't. I think it's a fantastic bank, but I do think that resources are taking a little bit of that fund flow or that money flow, and that is certainly keeping CBA with a bit of a lid on it at the moment.
And at the same time as we've seen this bit of rotation into resources, we're also seeing quarterly reports from now or on Friday of Westpac and today National Australia Bank, and those banks rally. Do you think there's a bit of a rotation occurring from CBA into Westpac and the NAB?
Yeah, on the other financials, yeah, look, absolutely. You can certainly see that becoming more prevalent when you look at something like Westpac or even ANZ rallying to those sort of near-time highs, and you're just thinking, what the hell's going on here? So yeah, we are seeing a little bit of that rotation into the other financials and potentially catching a little bit more of a bid. I'm actually interested to see MA Financial, which is we're going to be reporting this week, I think, also. And that's one's going to be quite interesting for some of those non-bank lenders just underneath the bank and how they're going as well. We expect them to be reporting quite solidly as well. So it's an interesting sector, the finance sector at the moment.
Okay, let's move out of finance and look at a couple of others that have reported. We had Telstra last Thursday. Again, pretty much as expected, the market sold off. Telstra just too expensive at the moment?
Well, geez, had a good run, hasn't it, Paul? Like, it really has had a good run, and I think that that's probably a little bit of that sort of taking a little bit of profit because, you could basically invest in this one because it's a boring utility with a decent dividend yield. What else is going for it? Well, they can start to clean up some of those businesses, hive off some things, simplify the business. But I don't think we got a lot of direction in the result on that one. But look, certainly Telstra does look okay. Good boring utility, good dividend yield. But yeah, up here does look a little bit expensive. Remember, this thing traded 360, 380, and $4 for so many years, and now only starting to get a little bit of a wriggle on. But yeah, that was one that I was a little bit surprised that it did take a little bit of a hit. I thought that we might see some more buying coming into Telstra because of that utility side of things that it has, and potentially if this market decides to have a little bit of a wobble, gravitating to those defensive kinds of stocks, and Telstra definitely sits in that category. I thought it might have got a little bit of a bid, but I thought it was a good result all round.
Okay, so you're not advising portfolio clients to ease up in Telstra at the moment, is that? If,
Look, I mean, I just today, but the client was 15, 16% in Telstra, so I sort of wanted to pull back another 5% to try and bring it back. But most clients are sort of fairly weighted in Telstra and have done well in it. It's sort of like a Commonwealth Bank. It's pretty hard to get people to sell these things. They've owned it since T1 or whatever, and it's just a little bit tough. No, it's more about portfolio weighting more than the actual company. One of the ones that I'm a little bit worried about is Wesfarmers. I think that one's
yeah.
priced to perfection as well. And it's going to be interesting to see how the market does take that. I've got no idea what the result's going to be, but I'm hoping it's going to be good because yeah, that's certainly something that could have a little bit of a wobble if it doesn't report well.
Yeah, I've been worried about Wesfarmers for that very reason. You just wonder how, because 60% of Wesfarmers is Bunnings, and you just wonder how Bunnings can keep growing and keep improving margin, right? So
Yeah.
it wouldn't take much for that to slip up. You wouldn't think just a touch. Let's move on to some others that have reported some perhaps more in the growth categories. We've had good reports, I guess, both from car sales and REA. Anything you'd like to talk to us there about those two companies?
Yeah, look, car sales, I think, it's one of those old boring growth stories, I guess, in the Australian market. And I think it's around about 50 or over 50% of its revenue now comes from international
Hmm.
markets. So I think this becomes a little bit more of an Aussie dollar story than potentially what what people think, being just car sales here in Australia. They are very well across many other international categories. So look, I thought the result was okay. There wasn't anything that really sort of stood out for me. Obviously, car sales as a business or a car, new purchases have slowed down. The electronic vehicles have slowed down, those kinds of things. So I think they're still grappling with how they're going to do that. And like REA, they've got really good levers that they can pull. One, to get more revenue out of that car sales or the real estate agents getting on top of the list and getting more priority and those kinds of things. That's something I think REA can do really, really well. It's interesting to see on REA and how they're going to deal with the competition from Domain and the American entrant into that space. I think the market is getting a little bit concerned about potentially those margins and how much money that they're going to put in there. So REA, I thought was an okay result as well. A little bit up today on that one, but a very good business as well. And as I said, those levers can generate more revenue. So it'll be interesting to see because I don't think this housing market is going to slow down at all with more interest rate cuts further towards the end of this year.
Let's go to a stock at the other end of the market that's probably battling a couple of tailwinds. It has been a pretty firm favourite with the market for some time, and that's Amcor. But it's taken a bit of a dive the last couple of days. Do you want to just sort of talk me more through what's going on with Amcor and whether you think there's any value there now?
Yeah, so I listened to the call as well. I was up sort of early in the morning and listening to the call, and I really couldn't see that much wrong with it. They did say costs were, I thought everything was sort of fairly in line, but the US market hit it pretty hard, and that's why then we followed with it the day after the result. And then even today, we're still seeing some really sort of good selling. I actually bought some on Friday thinking this one doesn't look too bad. And a little bit underwater at the moment, but I still feel that overall defensiveness of that business is still going to shine. And I think if this market does come back, you're going to see these stocks getting catching a bid because of that. So the result I thought was fairly in line. The one I was actually really impressed with was Aurora, the old packaging business from Amcor. They actually surprised on the upside for some of their bottles and glass bottle side of things and alcohol and things like that. So maybe a little bit of money coming out of Amcor into something like Aurora, which has been a perennial disappointment to the market for so long now. So that's probably catching a little bit of a bid. But overall, I think we just followed the US lead, which was unfair and unfairly treated. But it is still seeing some selling at the moment. So it is interesting to see how Amcor can sort of move forward. But these guys are very smart and do a lot of R&D, and you got to back them. They've done very well.
Okay, a couple of quick questions to close. Qantas copped a $90 million fine for its for sacking all those workers. Is that something investors should be worried about?
I think it was one of the largest fines that has been sort of given out in that airline space. So I think, investors should definitely look at it, but I don't think it didn't really move the needle too much on the market as such. So I don't think it's a major, but investors should definitely be looking at that, and certainly around AGM time, they should be voting. If they're not happy with the way the company's being run, they should be voting and letting the directors know. I think that's certainly something that'll be interesting to see in AGM season coming up soon.
And finally, CSL's due to report on Wednesday. Just how important is that in terms of its current share price and outlook?
Yeah, I mean, CSL's obviously caught a bit of a bid over the last sort of 3 or 4 weeks, and now sort of starting to move sideways. Look, it does need to report well, and it does need to give confidence to the market that this Vifor acquisition is now being bedded down and moving in the right direction. And I think they're the two things that I'm going to be looking for, is that acquisition, and hopefully they can up their dividend a little bit. It's not a huge dividend, but I think that might provide a little bit of confidence. And certainly the healthcare sector is one of those sectors where we are going to see some good earnings per share uplift throughout the whole entire sector. So CSL is going to be a big bellwether. We saw ResMed report really, really well. CSL needs to do that also to keep the market's confidence on the stock.
And just to finish, Adam, market at record highs. Is there any stock that's really taking your fancy at the moment?
Well, look, certainly, I think that MAF, I spoke to that, the MA Financial, which is the old Models Group. I think that they're going to report really well. And so, again, that's priced to perfection and near all-time highs. But if these guys can actually do it, I think this one's going to look quite good. So MAF is a good little one to have a look in that sort of financial side of things.
And just remind for the viewers what MA Financial does.
Yeah, so it's a finance business, but it's a second tier lender. So it lends to all of the businesses that the banks don't lend to anymore, and then they've got a lot of debt and sort of they could continue to do that. So second tier lender, they've got lots of other stuff in there, but that's the primary business. So there is risk obviously because it's not a big four bank. And if anybody looking for a little bit of spice in the portfolio, that's something that they should definitely keep an eye on.
Well, Adam, some great insights as always. Thanks for joining us on Switzer.
Great to be here. Thank you.
That was Adam Dawes, the Senior Investment Advisor with Shaw and Partners. Now, that's how a broker looks at things, but what's often interesting is to understand the process that a really great fund manager goes through. Here's an interview that Peter did a couple of days ago with Paul Black. Paul, of course, is the CEO of WCM Investment Management, those fantastic managers of WQG and WCMQ. Here's Peter with Paul Black.
Good to speak with you, Paul.
Thank you, Peter. It's great to see you again.
Yeah, same here, mate. Can you just give a background of who you are personally? What is this business? And, why is it your style of investing quite unique?
We are a $115 billion asset management, money management firm, and we're known around the world for running global equities. We've got a very enviable track record over 15, 20 years. We've been doing it a long time. And I always think of our firm as a bunch of people who are complete learning machines, always trying to iterate and get better at our craft. And that's proven to really be the case, especially in the last few years when the markets have been very, very difficult. We actually bought this firm in 1998 from the original founder when it had only $200 million under management. A lot of what we talk about, and we'll talk about it, I know, Peter, is around people and culture and how important that is to anyone's success organizationally. And that's the gift the founder gave us, because he was a completely toxic person with a very toxic culture that crushed the hearts and soul of the people there. And we actually learned from him what not to do. And we've created something really special here in California. Look, every organization is about people. People like to make these stereotypes about these inanimate objects called corporations. But the reality is people make up those organizations. And what we look for is we want to find the set of values in the organization, what those values happen to be. We look for alignment between the values and what they're trying to do on a strategy side. That's really important. So in a retailer, for instance, a great retailer, every great retailer you and I have ever walked into has happy employees, right? Because it's so obvious. If you have happy employees, we're going to have great experience. We'll come back, shop more, and the shareholders would do better. But that may not be the right corporate values for an industrial company or a tech company or even a railroad company. They're going to have very different values. But the key point is every company has a set of values, and what you try to find, and we try to find, is an alignment between the values of the business and what they try to do on the strategy side. And the reality is, when I talked about the founder early on, about how difficult he was, that the gift he gave us was how important culture and people are to the success of an organization. We've got to fix this culture that's highly toxic. How do we do it? Well, what would the founder do? Let's go 180 degrees the other way. We'll probably build a really nice, healthy culture. So he owned all the stock. Let's build a company where, now 67 people own shares in the company. That's magical, because when people own shares, they behave and act very differently. They act like owners. Pay was very opaque. Let's make pay very, sounds basic, but let's make it really transparent so people know exactly how they're going to be compensated, and there are real metrics there. And then in terms of, I tell this really funny story. Every day he would walk in the office, and we had 12 people at the time, and he walked back to his office and he closed the door at 8:30 in the morning, and wouldn't come out until he left at 5:30. And the only way you could talk to him is he had a mail slot on his door. You'd have to write a little note and say, "Hey, Daryl, can I ask you a question?" Put it through the mail slot, and he may or may not answer it. You may just sit there for 15 minutes waiting for him to answer. Well, we went as far away from how he ran the company as we possibly could, and we empower people. We try to get people into the areas of genius. We care about people. It sounds so basic, but if people know you care for them, they'll give you everything they have. And as a result, we started to grow. And then a few years later, it dawned on us, my gosh, if this made such a difference to us, we ought to start doing this with the companies we invest in.
You are a sharing, caring kind of guy, Paul. How does someone, identify a company with good culture?
It is a lot of work. Everyone thinks, we can talk to any CEO in the world because, we're big enough. We own enough. We're probably on the top 10 shareholders of most of the companies we own. They're easy to access for us. But those aren't the people you want to talk to, right? Because you're going to get a scripted response. Your best responses come from the line workers and like you said, standing outside the factory when the factory closes down and asking a series of questions. That's a brilliant way. So vendors, people that sell to them, competitors. We love to ask one company, which competitor do they fear most and why? So again, this is work that takes months and months of time to do from 4 people. But you do start to create an incredible mosaic of what behaviors are honored in the organization.
So let's talk about another company that's been fairly important to you this year, AppLovin. What's the growing competitive moat that you see there?
So what AppLovin does is they actually created the advertising for mobile games. So if you ever play a mobile game and on your phone or your iPad and an ad pops up, that has been created most likely by AppLovin. That's what they're known for. And sometimes they're annoying, but they work. So they have figured out an algorithm where they say, okay, the average age of somebody playing this particular game is 35. So this is the right ad to associate with that game. You and I, Peter, they're going to sell us geriatric, ads all day long because, we're going to play games that the older people play. They've-
Luxury cruises, Paul. Luxury cruises.
Luxury cruises. I like that better. But they literally have built an algorithm using AI that it's a kind of a black box, but it works brilliantly for tying advertisers to the players of the game. It's been very efficient, but this is why it's so exciting. The reason is we're so excited about it is they are now moving into e-commerce. So they're going to take that model that's worked really well from mobile gaming, and they're going to now go into e-commerce and with this same algorithm that's just crushing the competition. And so the market for them has gone from maybe this big to this big. They have been brilliant at taking market share across the board, and they will continue to take it as they move into e-commerce. So in 2022, we didn't just sit there and say, this is what we always do, let's just keep doing it. This is the time when we have to separate ourselves from the pack. The way to do that is, in our mind, was to really think more of where are companies inflecting upwards from here. Now, this is like at the trough of 2022. Where are companies starting to inflect? It may not just be in technology. It may not be in only healthcare or consumer names, which are the names that most growth managers own. And when we started doing that work, looking for companies that were inflecting upwards, about 3 years ago, we found that, aerospace is an interesting space. Most growth managers don't buy aerospace. We have an aging fleet of airplanes across the globe, and they're going to have to be replaced. And companies that supply parts for those airplanes are probably going to do pretty well. So we made some investments in aerospace that have just performed beautifully. Defense. Now, this is really interesting. European defense in particular. We started looking at the European defense companies, and we started to see these inflections upwards in their financial performance. And, of course, now, with Europe having to arm itself and actually invest more in defense companies, we were very, very early to that general idea. We continue to own those names. We think that, and they've done, we've got a couple of companies that are up 200 or 300% in 2.5 years in the defense area. Even things like gas turbines, which, oh my gosh, growth managers don't buy gas turbines, but why would you buy that? Well, data centers. I mean, I'm sure Australia is building data centers everywhere they can find space for them. They use a massive amount of energy.
Paul Black, you're not only a great fund manager, you're actually a great American. And I don't say that to many Americans. You know that.
Well, I have an American flag behind me, and you can see I turned it around so it wouldn't annoy your people.
Thanks for joining us, mate. Thanks for joining us.
Thank you. Great to see you, Peter. Take care.
Those were highlights of a chat between Peter Switzer and Paul Black from WCM. To see the full interview, click on the link on the screen in front of you. And that's it for another week. We'll be back at the same time, same channel next week. We'll see you then.